Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 127 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, what we are going to talk about is value investing. And we have talked about some of the tenets of value investing previously, but I have not dedicated an episode to it. I've talked about books like The Intelligent Investor that talk a lot about value investing. I've talked about The Most Important Thing, which is a book that has a lot of the inner workings of value investing within it, but I have not dedicated an entire episode to value investing, what it is, and how you can benefit from it. So that is what today is going to be about. And hopefully you can benefit a lot from this discussion of one of the investing strategies that many people worldwide take on every single day. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you put down there. If you're listening on Apple or Spotify podcasts, then just be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplementary materials to all the things I'm putting out on these long form episodes every single day. And then if you need somebody to help you with your financial situation, create a financial plan that's specific to you and your family and keep you accountable to that plan over the long term, then I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So let's just start with what is value investing. Well, Warren Buffett is probably the most famous value investor of all. Warren Buffett talks a lot about some timeless investing principles, and those really center themselves around this value investing strategy. So what value investing is it is an investment strategy that focuses on stocks specifically. So value investing can have to do with any particular asset class, but most typically what we're going to talk about is stock market, and that's what we're going to just put our focus on, especially in this episode, because that is where many of you will be investing and maybe employing a value strategy within. And so it focuses on stocks that are underappreciated by investors and the market at large. And the stocks that the value investors seek typically look cheap compared to the underlying revenues and earnings from their businesses, and investors who use the value investing strategy hope that the stock price will rise as more people come to appreciate the true intrinsic value of the company's fundamental business. And so basically all we're saying is when you are value investing, what you're trying to do is purchase things that are currently selling for less than what they are worth. Well, you may say, obviously, isn't this something that everybody is trying to do? Isn't this the whole idea of investing, is buying something for less than what it is worth? Well, one would think so. But there was a key to that definition that I think we should really key in on. And it was stocks that typically look cheap compared to the underlying revenue and earnings. So with value investing, you're not necessarily focusing on just the price or just the movement of the stock or the stock chart or any type of technical analysis. You are focusing on the fundamentals of the company. And relative to the fundamentals of the company, what price is the company trading for and what price should the company be trading for? And that helps you make a decision of what price you should pay and whether or not you should invest in some asset. And so what this brings about is this idea of intrinsic value, because obviously with value investing, what you're trying to do is determine what the value of something is today. Well, the intrinsic value is that. The intrinsic value is the value of something today. Now, that is not the price for which it is selling. That is what it is worth based on its fundamentals today. And obviously, intrinsic value differs based on the set of assumptions that you use. Because as investors, we are trying to determine what intrinsic value is. That way we can determine if a particular stock is selling for more or less than what it is worth relative to its earnings, its cash flows, its revenues, things of the like. And so intrinsic value is something that we try to find. And then I've talked about this idea before. We try to take intrinsic value and we try to find this margin of safety between intrinsic value that we find and the market price for which something is currently selling. Because, like I said, the intrinsic value depends on the set of assumptions that you make and the beliefs that you have about a particular company in this case. And if that set of assumptions is slightly off, it can impact what the intrinsic value is. Therefore, you want to create a reasonable margin of safety, which is the difference between the market price and the intrinsic value. That way, even if you're a little off with your intrinsic value calculation, you can still make a considerable gain on whatever you choose to invest in. And so the greater the difference between the intrinsic value and the current stock price, the greater the margin of safety is, because not every value stock will turn its business around successfully. So not every value stock will get back up to the value that they are worth. And that's a very important thing to note, is that even though you may find something that's selling for less than it's worth relative to its earnings and its revenues, there may be something inherent to the company that doesn't allow it to trade for that value that you think it should be trading for. And so if the business doesn't get to that value, the margin of safety is important for value investors so you can minimize losses when you are wrong. Because we've talked before about when you are investing, it's not a crapshoot. It's not just a flip of a coin. It's nothing like that. Peter Lynch calls it's like playing 5-card stud and you can see everyone else's cards. And I think that is a perfect idea of exactly what it is. And you can be playing a lot of hands at the same time. So dealing with a lot of different stocks at the same time. And so I agree with that. And I think there is a certain level of risk, and you can be wrong. You can look at a company's fundamentals and determine an intrinsic value and find a margin of safety and still be wrong when it comes to how you choose to go about investing in that particular stock. But that is what the margin of safety is there for. And that is the big idea of value investing. The big idea of value investing is we are going to find what the value of something is, what the intrinsic value is, compare it to what the stock price is, and then determine if we're going to invest in that particular stock or not. Now, then the question becomes, well, what makes a great stock that is a value stock, that is a value investment? Well, defining a value stock is basically just saying it is inexpensive relative to its revenues, earnings, cash flows, and other financial metrics, things of the like. However, the best stocks have these attractive characteristics that you would find, and you would say, oh, well, these are characteristics of a particular stock that we like and that help us to determine our intrinsic value and make the best decisions that we can when it comes to the long-term value of a particular company. And so these are just a few things that we would look for that would make really, really good value stocks. The first one is a well-established business with long history of success. And obviously the reason that is because the longer that something is established, then the easier it becomes to determine what the value of that thing is. It is not easy to determine value just based on some short-term success. It is not easy to determine value just based on just a company recently going public or a company that struggled for a long time and now is turning it around. It's not easy to find value in those particular situations. But if a company is established and has a long history of success, that would be an interesting company to look at when it comes to trying to find a value play. And then you also want to find a company that has consistent profitability. It is very hard to determine the value of something if it has negative earnings. And that is true whether or not you are looking at a value stock, whether or not you are looking to invest in this type of way. If you're trying to find the value of any particular company, it is difficult to find the value of a company that has no earnings at all or has negative earnings in many cases. And so we want to find a well-established company that has consistent profitability, been profitable for a period of time. That way we can determine what the growth rate of that profitability is and whether or not that profitability is sustainable over the long term. And that will help us to determine what our intrinsic value will be, and it will help us to determine whether or not this is a great value stock or not. Then we'll also look for stable revenue streams without huge amounts of growth, but typically also without big contractions in sales either. So we're looking for stability in revenues, because when it comes down to it, when you're looking at what the value of a stock is and you're trying to determine whether or not you should invest in something, you have to be able to determine if that particular company is creating revenues. Now, earnings are extremely important. Cash flow is extremely important. But if you're not selling anything, if you're not actually able to make sales and have revenues in your firm, then there will be no cash flow. There will be no earnings. And so having some stability in sales and being able to see that there are revenue growths within these particular types of companies, but you don't see a lot of ebbs and flows. It allows you to have a better idea of what future revenue streams are going to look like, and therefore determine what the intrinsic value of a particular stock is today. Because when we are trying to determine what intrinsic value is, we are taking the present value of future cash flow. So if you wonder why we look for consistent profitability and stable revenue streams, because if we want to determine what's going to happen in the future and discount that back to today, then the only way that that can happen is if we have some general idea of what the future will look like. And the future is better predicted by things that are more stable and consistent than things that fluctuate a lot, or a company that may have, negative earnings and the earnings pop positive or whatever it may be. That can really throw growth rates off, and thus that can throw off your intrinsic value calculation quite a bit. And then another attractive characteristic of a value stock, of a value investment, is dividend payments. And this is not required, obviously. And we talked yesterday about what dividends are and why they matter and why they can help us. So we know that dividends can be reinvested over the long term and help us to build long-term wealth. And we know that dividends are companies paying out pieces of their earnings to their investors. But the whole idea is that if a company is paying dividends and have done so for a long time, that again helps us determine what intrinsic value is, because you can discount their dividends back. And that is an extremely useful thing to do, especially if they have grown their dividend over time. Again, this is not a thing that you have to do. You do not have to have a dividend stock to have a good value stock. But if something does pay dividends, the dividends are growing consistently or are relatively stable, then we can get a good idea of what the value of that particular company is, if it also has, the stable revenue streams, the consistent profitability, and is a well-established business that has long-term success. And so if it has all of those things, then we may be looking at a very, very good candidate for a value stock that we might want to invest our money in. And so if you see these things, it is important to understand that a company that has them isn't necessarily a great value stock. Okay. So even though a company may have all of these things that we just said, it doesn't mean that it has to be a great value stock. Sometimes a stock only appears to be a good value for investors, but is actually a value trap. And value traps can continue to suffer share price declines even when their stocks seem attractive. And what this idea of a value trap is it is a stock or another investment that appears to be cheaply priced because it has been trading at low valuation metrics. So things like your price to earnings, your price to sales, price to book, price to cash flow, things like that. And what a value trap can do, it can attract investors because it looks like there's a lot of value to be found in a particular company. Because those investors are out looking for a bargain. Because when you are value investing, it's just like when you are value shopping, you are looking for bargains. And so investors are out looking for bargains. They think that they find one because it seems inexpensive relative to its long-term historical valuation metrics. But there is a problem. And the problem is that the stock may continue to languish or drop further even after an investor buys into the company. So again, there may be something that is inherently wrong in the stock. And the whole reason for this value trap is that you have this poor investment, right? That looks good. It looks like we may have something to invest in, but it becomes a poor investment because the low price and the low multiples is because the company is experiencing financial instability and has little growth potential. And that is part of the key of all of this is growth potential. Just because a company has done something in the past and looks like a good company that you may want to invest in doesn't necessarily mean that the future is going to hold the same fate. So even though we like the consistent profitability, we like stable revenue streams, we like things that we can forecast into the future, it doesn't always mean that they do. It doesn't mean that the growth always forecasts into the future. So if there is no future growth, or if there's very little future growth, then discounting that future growth back to today will really put a damper on multiples and a damper on the share price for the particular company. And that can make you fall into this idea of the value trap. So then the question becomes, why would we want to invest in value stocks? Why would we want to invest in value companies? Well, everybody likes a bargain, right? We go shopping, we like a bargain. We like to find things on clearance, things on sale. But for some reason, a lot of times in the stock market, we want to buy the things that are rising in price. And it's like, people look at those things that are rising in price as some status symbol, like we do with things that are very expensive with consumer goods. But it doesn't make a lot of sense. Why would you not want to buy something that is on sale relative to what it is worth? Because I'll just tell you this. There are times when I'll go shopping and you'll look at something and you'll say, well, I'd really like that, but that's just, that's a little much for that. But then you come back later and that thing's 30% off. Well, you would likely buy whatever that is. Well, the same thing goes with stocks. The same thing goes with value stocks, is that, it's one thing if something is, exactly priced perfectly, or maybe is priced a little above what you think it is worth to you. But if you come back later and that, that hoodie or those shoes or whatever it is cheaper, substantially cheaper, and you think that it's a good price for that, and you're getting a good bit of value out of it, then you would purchase it. And the same thing goes with value stocks. So everybody likes a bargain, and all it takes to make money with a value stock is for enough other investors to realize that there is value to be had. Because it's the whole thing, and that's something that I said at the outset that I didn't really key in on, but is very important, is that a lot of value stocks are just stocks that are out of favor at the particular time for no necessary reason, maybe, or maybe there is some reason that didn't actually play out. But these stocks may be stocks that just the investing public either doesn't have their eye on very often, or they think that those companies aren't as good as they actually are. But if enough investors pull together and realize that there is value to be found, then you will get big increases in value. And once this happens, the share price should go up to reflect the higher intrinsic value. And those who bought in a discount will obviously get their profit. So those who bought at a significant discount to the intrinsic value will be able to get their profits out of the company. And furthermore, many investors like the margin of safety provided by a stock that's purchased for less than what it's inherently worth. So investors actually like that space. They like that difference between what something is selling for and what something is actually worth. Because if you're buying a different type of company, just some high-flying growth company, which we will talk about growth investing and growth companies in tomorrow's episode, but if you're buying a company like that, that company is constantly pushing at high multiples, and that company is constantly increased price, and likely selling for more than what their current fundamentals say that they should be selling for, because they are discounting a lot of future growth back to today, thus increasing the share price that is in the stock today. And so if you have companies like that, then it is almost impossible to find some margin of safety, because what the current fundamentals would tell you that the intrinsic value is not likely to be above what the current market price is. So it's likely to be below what the current market price is. And in that case, then you have a situation where something is trading above its intrinsic value, which means that you don't have any value to find in it, and that it is a lot more ambiguous as to whether that stock will be able to keep up and will be able to keep pushing forward with the growth assumptions that investors are making. But when you have some fundamentals and you have this function of earnings and revenues and cash flows, and you can actually look and go, okay, I have this margin of safety. There's this difference between what it is worth, and what it is worth is actually greater than what it's currently selling for. Then there is value that actually can be found in those particular types of companies. Now, value stocks are also seen as defensive stocks a lot of time, and that can be true, but you can also earn very, very good returns in value stocks. And so for those who see themselves as like defensive investors, people who don't want to take a lot of risk and want to just really minimize the likelihood of big crashes in their portfolio, a good value stock can provide both protection against losing money. And so, just think about it for just a second. If something is already trading for less than it is worth, and let's say the market as a whole has a crash, right? The market as a whole has a hard pullback, then that stock is probably far less likely to actually decline as heavily as the market, because it is already trading for less than it's worth, and the market in a lot of cases can be trading at or above what it actually may be worth based on fundamentals. And so it can decrease your risk, your volatility in that way. But once the market and investors recognize the value that is in whatever stock we're talking about, then you can get a really, really good payoff from a good value stock. And so that is something that defensive investors can take advantage of and still make really, really good returns. But value investing can require patience, because the truth of the matter is that if investors haven't found that there is value in something to this point, then it may actually take them a while to realize the value that you've realized in something. And there's so much information and so much about companies out there. And it doesn't mean that things are priced perfectly. And it doesn't mean that people are using information correctly. It just means that if you're looking for a good value stock, then you're likely going to have to go fishing in a place where a company is not heavily followed by analysts or have a lot of institutional ownership or whatever it may be, because the less eyes that are on something, the more value that can be found within it. Because if a lot of people are constantly looking and analyzing and trying to figure out what something is worth, then there's going to be a better idea of what it's worth, and the market is going to reflect that idea. But the fewer eyes that are on something, the fewer eyes that are on a particular stock, then the less likelihood we have of actually knowing what that thing is worth and realizing it in the market. And it can also force the stock to be trading for less than what it is actually worth. But you have to be patient. You have to know that there can be a lot of time between when you make the determination and when you buy. And so there's a saying that I've heard multiple times, and it's, there's really no difference between being early and being wrong. So even though you may need to be patient, you still need to allow yourself for enough margin of safety and enough determinants of there's going to be growth in the future that will actually show up in the stock price. That even if you allow yourself to wait, you will still make good returns, because you don't want to wait. And you fall into that value trap and you never realize the gains that you thought you would realize. Now then the question becomes, well, how do we avoid value traps? How do we avoid the situation where the company's value, the company's intrinsic value, is never actually met, and we continue to trade for below that intrinsic value and at very low valuation multiples? Well, there are a couple situations in which value traps can be found, and so you should watch out for these particular situations. So stocks in cyclical industries like manufacturing and construction, they often see their earnings rise substantially during booms, and a lot of those earnings may disappear when the industry finally cools off. So when investors see possible busts coming for a stock, its valuation will look very inexpensive compared to recent earnings. So if you're looking at this type of cyclical industry, and you're looking at a stock within the cyclical industry, remember that the information that you have is from the past, right? The earnings that you see are from the past. The revenues that you see are from the past. And understand that, again, that doesn't necessarily mean that growth is going to continue into the future. So if you look and you go, oh, based on what I see here and what the future growth rate should be, this stock should continue upward, and there should be no reason that it's selling as cheaply as it is. But what the market priced in that you failed to do and failed to take into account with your growth assumptions was that in the future, that company would not have those types of earnings and revenues that it had previously. So you want to look out for that because that can allow you to fall into the value trap to where you're just floundering and not meeting the intrinsic value that you need to meet. And then stocks in areas that emphasize intellectual property are prone to become value traps. So for instance, if a drug company has a high selling treatment but is losing patent protection for the near future, then much of its profits can disappear quickly. And this happens with drug manufacturers very, very commonly, as they will lose their patent protection, and so there will be generic drugs that come out that undercut them in price. Therefore, their revenues and profits fall away. So the profits that you may have seen in the past based on the drugs that they have had and the drugs they've had outstanding that they could sell and make a lot of money off of those drugs because there could be no generic for them, then that is going to go away in the future. And if you don't take that into account, then you can end up being in a place where, again, you are floundering within a value trap. So if you want to avoid value traps, just remember And so if you want to avoid value traps, just remember the future of a company is more important than its past when valuing a stock. If you focus on a company's prospects for sales and earnings growth in the months and years to come, you'll likely be able to find more of what the true value is. Now, again, this is not to say that the past doesn't matter. Again, an attractive value stock has had consistent earnings and stable revenues and a long-standing business and long-standing success. But that does not mean that success will continue into the future. So take a deep dive into these companies and really pay attention to what you're looking at being in the future, not just looking at the past and assuming that the past will continue. Now, for those of you who do not pick individual stocks and actually just buy mutual funds or things of the like, well, there are mutual funds that are value mutual funds, and they go about trying to purchase these types of stocks and try to do the same thing, try to find things that below their intrinsic value and see the price of the stock actually reveal the intrinsic value later on. And these types of mutual funds can provide some level of stability into your portfolio. Like we said earlier, they typically put off dividends, even though they don't have to. These types of companies typically put off dividends. They're typically larger and more stable. And so it'll put some type of stability into your portfolio, but it can also be a little bit of a drain on returns, especially given that a lot of the stocks that these mutual funds hold in high percentages are going to be large companies that have already found a lot of their value already. So just keep that in mind, but it is something that if you are a fund investor, you can purchase value mutual funds, and they can be very useful. There's a lot of them that have done a lot of good over the long period of time, but just understand what they're investing in and understanding exactly what they are doing within that mutual fund and what that fund manager is doing is very important, and hopefully this video, this episode has helped you to do that in this discussion of value investing. So you maybe know Warren Buffett or Charlie Munger or Ben Graham or whatever it may be, or Peter Lynch, but hopefully today has helped you to know how we can go about value investing and the things to look out for in the way of value traps and things of the like. So hopefully this helps you to become a better investor and understand the things that you are investing in better and how you can go about finding value in the stock market. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I will be sure to get back to you there if you haven't done so already. If you're listening on Apple or Spotify podcast, then make sure that you subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's good supplementary materials to the things that I'm putting out in these long form episodes every single day. And then if you need somebody to help you in your financial life, help you to create a plan and keep accountable to that plan over the long term, then I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can select the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as we change gears just a bit and go from value investing to growth investing. And hopefully that will be very helpful for you guys, and you can juxtapose the two and you can try to figure out how you want to go about investing in your own life. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.